With the French presidential elections now behind us and the markets having fully priced in a Macron win, where now? Well, politically, France is far from through the woods, as there are now parliamentary elections on the 11th and 18th of June. And later in the year, of course, there are the German elections as well to consider for the Eurozone. But politics aside, what's going to be the market focus for the summer? Karim Chedid joins us now from BlackRock. Interesting developments over the weekend. I guess it was pretty much factored into the markets, of course, last week, wasn't it? I think if you look at the broad spread of where the money's going in Europe, a little bit of money's coming off the table in European equities. London's FTSE is holding on to the gains. What's your comment for the markets after this win for Macron at the weekend?
So I think it's important to compare what has happened since the first round of the election to what's happened yesterday. And to your point, a lot of the positive reaction on Macron's victory has already been in the price. Doesn't mean that his victory is not perceived as positive for markets. It is. He's a centrist and he has a reform agenda which is seen as market friendly. But it's that a lot of the move has already happened between the two rounds. European equities already rallied, the euro already rallied, and a lot of the moves have been established. Now the focus is turning to the legislative election in June. Macron's expected to appoint an interim prime minister imminently to tie us over until that election. And there are doubts about how well he'll be able to do at the legislative elections, because he is a new party, En Marche. It's not an established party. He's going to have to get some supporters from ex-Republican or ex-socialists to rally behind him in order to get the reform agenda that is seen as market-friendly through. So it's not out of the woods, as you say.
But ultimately, what could end up happening is that he's going to end up with such a patchwork, as we say in English, of candidates together. There's going to be no consensus, going to be no agreement. They're not going to be able to get any laws passed, ultimately.
It is a risk. And the fact that a lot of the rally already happened before round one, and the fact that there are market doubts about this risk that you articulate so well, are probably behind why the markets are not doing as positively as we would have imagined this morning.
What about the market focus from here? Because French elections aside, you've got here more evidence this morning on the German economy, the numbers out today, the industrial production figures doing well. We've got trade out tomorrow. We've got all sorts of evidence to show the German economy is doing well. The rest of Europe is not so. When's the focus going to shift back onto the ECB and the Eurozone as a whole?
So I think the less we're focusing on politics, and with the French election risk, a lot of the political risk in the Eurozone this year is now behind us, the more we can focus on fundamentals. And I would break up fundamentals into two categories. The macro, so the factory orders, the hard economic data that you've alluded to, which are coming in positively. There is a strong macro recovery in Europe at the moment. And the second category, the micro, earnings. Earnings are doing well. We are now more than halfway through the earnings season in Europe, and we are running at double-digit earning growth for the second quarter in a row, which shows that the positive numbers that we saw in Q4 were not a one-time thing. They were part of a positive trend that is now continuing. So those two catalysts, the macro and the micro, are important to look at going into the summer and are positive for European equities.
And certainly this would seem to underpin what you've told us about before, about BlackRock's approach to European equities as being positive this year against the rise we've seen recently, of course, in the States. So you still hold on to the expectation that we'll end the summer higher in European equities than we are at the moment?
Yes, and higher relative to the US market. So relative value in Europe still. Underpinned by the macro and the micro fundamentals.
What about the UK? Because a bit of a different situation, of course, here, and indeed the election at the weekend, there's two ways of looking at this. You've got a very strong direction in French politics. If this is, I know you're not a political analyst, but I mean, if this is good or bad for Brexit negotiations remains to be seen. But should we take a positive here in the UK about, for the UK markets at least, about what's been happening in France? And now, of course, Germany later on looks like the political thesis that we had, the theme we've had over the last 10 or 12 years or so is going to continue with Angela Merkel potentially.
I think it's hard to analyze the UK, the Europe events independent of the election in the UK coming up in June. So let me take your question into two parts. On the Europe side, yes, the more decisive the victories on the continent, regardless who the candidate is, the more certainty we have about who will be negotiating with our government in the UK throughout the Brexit negotiations. So Macron in power, German election later this year, will get individual governments sorted out on the continent, which is better to face off of than just the European Commission because of election cycles for the governments. So in a sense, it is positive for the negotiations in that it gives us a clearer picture who we're negotiating against, and markets like certainty. On the UK side, markets are generally perceiving a decisive victory in the UK election as positive for the sterling. So during periods where the current government, the Conservative Party, is doing well in the polls, the sterling has been going up. And the reason is also going back to that markets trade on certainty. The more decisive the outcome, regardless of the politics behind it, the more positive it is seen for markets.
Just keeping this chart here, sterling up, we're currently just below the 130 level. This seems to be a bit of a stumbling block here at the moment. And indeed, you can see from this daily chart, we're at the highest now not seen, since the 2nd of October last year. Mm-hmm. So you see an appreciable gain for sterling, or is this going to be a gradual creep higher?
I would say it's a gradual creep higher from now until the election, given the way the polls are going. Mm-hmm. But I do think that part of it is going to be a buy the rumor, sell the fact type trade, where yes, right now we get a more decisive majority for the current government, positive for the sterling near term, but then as we head into the negotiations, the sterling is going to come back to be dependent on how these negotiations go, which could cause some volatility post-June in the summer, and how the economic data in the UK does. And the weaker the economic data, the more likely it is than not that the sterling would be vulnerable to it.
Okay, if we do see this creep higher, possibly in sterling, of course, that potentially is negative for the FTSE 100. So do you see, contrary to what we're seeing in the rest of Europe, do you see the FTSE underperforming?
Yes, so there is a very strong negative correlation still, ever since the Brexit vote until today, and even before, between the sterling and the FTSE 100. And the reason for this is that the FTSE 100 generates a lot of its sales revenues from outside of the UK. So when the sterling goes up, which it could well do between now and June, the FTSE 100 underperforms the mid-caps in the UK and underperforms continental Europe. But then when the sterling goes down, the reverse happens.
You talk there about the benchmark FTSE 100 correlating to sterling. How about the European markets correlating to the euro? Is there a correlation there? Because I'm hearing that I think out of the last 10 years, I think May has been the month where the euro has underperformed. It's lost ground. If that continues for this May, we're going to get a weaker euro by the end of May.
It could be another positive driver for European large caps. So here I would draw an important insight, which is that large caps in Europe, similar to large caps in the UK, which the FTSE 100 represents, are more negatively correlated with the euro because their sales revenue comes from outside of euro-denominated areas by and large. So indices like the top 30 companies in Germany, which is the DAX, or indices like the Euro Stoxx 50 would negatively correlate with the euro, which means that if a May plays out negative for the euro, as per the research that the historical research that you've pointed to, that could be a positive driver for Europe, on top of the positive drivers that I already spoke about.
Okay. One final thing I want to catch up with you is breaking news this morning from Russia that they want to support further restrictions in oil supply, supporting OPEC's deal that was hammered out, I think, in Algeria, of course, last November, wasn't it, initially? OPEC wants to drive towards cutting output, and Russia now wants to continue to help them support that. Positive for oil? Do you see oil rising over the summer?
So oil has sold off a lot year to date. It's back down in the low mid.
It's about $46.
Yes,
$46,
mid-40s,
so, yeah.
Which is an impressive drop. having that drop behind us, yes, there's fresh opportunities for oil to rally from here. However, we don't see it rallying too far, too quick. We do still see that with the shale gas revolution in the US and the dynamics there, where supply can come back on the market very quickly, we do see a cap in the high 50s, 60. But given how much the oil sold off, there is some opportunity between here and those capped levels.
Good. Okay, look, we've got to leave it there, but thanks for joining us. Karim Chedid there from BlackRock, taking us on a tour from European politics right the way through to US shale oil. That's it for this roundup. Join us again on IGTV and our video channel for more updates in the markets.